The truth no one tells you about dividend investing. It's not just about the payouts you see today, it's about what those payouts can turn into over time. $10,000 might not sound like much, but with the right strategy, it could grow into a portfolio paying you thousands every single year. And the best part? You don't have to add another penny out of pocket. In this video, I'll break down the math, share smart dividend strategies, and show you how reinvesting those payouts can turn a single paycheck into an $8,000 income stream every month. How do dividends work? Dividends are your share of a company's profits, paid out simply because you own a piece of the business. For example, owning shares in a company like Realty Income Corp means you're entitled to a portion of its profits, which it pays back to investors regularly in cash. It's passive income that feels like a bonus for putting your money to work. But how much can dividends actually earn you? To make this tangible, let's look at what happens when you invest $10,000 in dividend-paying stocks. The annual dividend income from a $10,000 investment chart paints a clear picture. At a 2% dividend yield, your investment generates $200 a year, enough to pay for a monthly Netflix subscription or a few coffee shop visits. At 4%, your income doubles to $400 annually, which might fund both your streaming services and your weekly coffee habit. A 6% yield steps things up further, providing $600 a year, enough to cover a utility bill or stash away for a weekend getaway. While these numbers might sound promising, chasing high yields isn't the whole story. There's more to dividends than just the cash flow today. That's where factors like dividend growth and sustainability come into play. For instance, a higher yield often comes with risks, such as slower capital growth or the potential for dividend cuts during tough economic times. Understanding this trade-off is essential to creating a balanced investment strategy. Another critical consideration is sustainability. Not all companies can maintain their dividend payouts forever, so it's vital to assess their payout ratios. A lower payout ratio means the company retains more of its earnings to reinvest for growth, which bodes well for future dividends. Meanwhile, a higher ratio may signal that the company is stretching its resources, leaving less room to weather financial challenges. A good rule of thumb is to go for companies that have a payout ratio of less than 60%. The real advantage of dividends, however, isn't just in receiving regular cash flow. It's in reinvesting those payouts to compound your returns over time. When you reinvest dividends, you use the money to buy more shares, which in turn generate additional dividends. Over time, this creates a snowball effect, exponentially growing your wealth. I will get into more detail on this later on when I show you an actual portfolio of stocks and how much you can earn in dividends. Dividends, when combined with a strategy that balances yield, growth, and reinvestment, turn your portfolio into a powerful tool for building long-term wealth. Choosing the right dividend stocks, ETFs, and REITs. When it comes to turning $10,000 into a consistent income generator, selecting the right stock is key. Not all dividend-paying stocks are created equal, and blindly chasing high yields can lead to disappointing results, or worse, losing money. Instead, you want a mix of stability, growth, and sustainability. Let's break it down. When selecting dividend stocks, prioritize companies with a history of consistent payouts and dividend growth. These are often referred to as dividend aristocrats, firms that have increased their dividends annually for 25 years or more. Look for companies in stable industries such as utilities, healthcare, and consumer staples. Assess key metrics like the dividend yield, payout ratio, and free cash flow to ensure the dividends are sustainable. High yields can be attractive, but may indicate financial stress if unsustainable. Dividend stocks are the bread and butter of many income-focused portfolios. Companies like Procter & Gamble and Home Depot are excellent examples. If managing individual stocks feels overwhelming, dividend-focused ETFs offer a diversified, hands-off approach. The Vanguard High Dividend Yield ETF is a great example, providing a yield of about 3.3%. It focuses on large-cap, high dividend-paying companies, combining a reasonable yield with a solid dividend growth rate of 7%. This ETF has also delivered an average annual return of 10.4% over the past decade, making it a reliable choice for investors who want broad exposure to dividend-paying stocks without the risk of picking individual winners and losers. For investors seeking passive income, REITs are excellent options. They are legally required to distribute at least 90% of their taxable income to shareholders, resulting in attractive dividend yields. Take Simon Property Group, for instance, which offers a dividend yield of about 6%. Knowing the stocks is just part of investing. How much can $10,000 earn you? Here's the big question. How much can you really make in passive income with $10,000 invested in dividend-paying stocks? The answer depends on the dividend yield of your investments. Let's explore what this looks like with 3 common scenarios: a 2%, a 3%, and a 4% yield. And let's do it with actual stocks. Schwab U.S. Dividend Equity ETF is a reliable fund offering consistent dividend income and long-term growth through diversified U.S. dividend-paying stocks. It begins with a dividend income of $341 on a $10,000 investment, rising steadily to $598 by the 5th year. This increase reflects both its 3% dividend yield and a 10-year CAGR, or compound annual growth rate, of 11.1%, which drives consistent capital appreciation. The higher CAGR ensures a steadily rising principal value, which in turn increases dividend income. Over time, this combination balances income with reliable long-term appreciation. Extra Space Storage Incorporated is a leading self-storage company combining strong income generation with impressive capital appreciation. It starts at $394 in annual dividends on a $10,000 investment, climbing to $796 by year 5. The 4% yield provides higher upfront income compared to Schwab, while its 14.1% CAGR accelerates principal growth. This strong combination leads to both increasing annual dividends and share price growth. Interparfums Incorporated is a global fragrance company emphasizing high growth potential and premium brand development over immediate income. Despite its lower 2% yield, it offers $394 in dividend income initially, rising to $742 by year 5 due to its exceptional 19.6% CAGR. This remarkable growth rate significantly amplifies the principal value, far outpacing the other companies in the long term. The performance comparison of stocks bar chart highlights the differences clearly. Schwab offers a middle ground with balanced income and growth. Extra Space delivers a stronger income stream with excellent growth, while Interparfums emphasizes explosive long-term growth over upfront income. While none of these options will replace your full-time income immediately, that's not the goal. Dividend investing is about building income and wealth over time. By reinvesting dividends, you can make sure to reach a solid retirement income. More on that later. Even though these 3 target different timeframes for growth, you can actually combine them to create a solid portfolio. Which brings us to the next step. Making a portfolio of these stocks? The key is to find the perfect balance between income, growth, and stability. For this portfolio, I plan to allocate $10,000 equally invested across all 3 stocks, totaling about $3,333 for each stock. By averaging the key metrics, the portfolio achieves a 3.25% dividend yield, a 14.93% annual dividend growth rate, and a 10.72% share price appreciation. This mix ensures steady income growth while allowing the portfolio's value to grow over time. Now, let's see what it's like to invest in this portfolio with actual projections. Portfolio without DRIP. You can see from the graph that the data reflects linear growth over time, driven only by capital appreciation. At year 1, the balance is around $11,000. By year 10, the balance reaches $27,000. At year 20, it grows to about $75,000, maintaining a predictable but slower trajectory. Finally, by year 30, the balance reaches to about $210,000. Portfolio with DRIP. Even though these are good returns, you can actually supercharge your portfolio if you do one thing: reinvest the dividends you earn from the investment. There's no need to invest anything out of pocket. Here's how much of a difference it can make. The year-end new balance with dividend reinvestment plan, or DRIP for short, compounding through reinvested dividends is evident. At year 1, the balance is still around the $11,000 mark, but year 10, it grows to $39,000. At year 20, the balance reaches $180,000, showcasing the compounding effect gaining momentum. Finally, by year 30, it skyrockets to over $1 million, clearly showing the exponential impact of DRIP over time. Comparison of portfolio valuation with and without DRIP. The comparison between balances with and without DRIP highlights the transformative effect of compounding. With DRIP, dividends are reinvested to generate additional returns, leading to exponential growth over time. In comparison, without DRIP, dividends are withdrawn, resulting in steady but limited linear growth. While the difference between the 2 approaches may seem small in the early years, the gap becomes dramatic over decades. By the 30th year, balances with DRIP exceeded $1.1 million compared to just $212,000 without DRIP, a nearly 5-fold difference. And the effect is not only seen in portfolio growth, It can also be observed in dividend income. Comparison of dividend income with and without DRIP. This graph provides a clear comparison of dividend income over 30 years between reinvesting dividends and taking them as cash. The reinvestment approach generates significantly more dividend income by the 30th year, nearing $100,000, while taking dividends as cash results in a cumulative income of about $20,000. So, the real answer to how much you can earn in dividends from $10,000 is way higher than you might expect. With a reinvestment dividend strategy, you can grow your portfolio to a valuation of over $1 million, generating more than $100,000 in annual dividends. That's over $8,000 in monthly dividend income for your retirement. The reinvestment strategy leverages compounding, where dividends are used to purchase additional shares, which in turn generate even more dividends. Over time, this creates a snowball effect, exponentially increasing income potential. On the other hand, taking dividends as cash leads to consistent but limited income growth, as the initial investment does not expand beyond its original capacity to generate payouts. It all boils down to this. To maximize dividends from $10,000, focus on reinvestment, diversification, and steady growth. Combine blue-chip stocks, growth companies, and REITs while avoiding unsustainably high yields. Use tax-advantaged accounts to accelerate compounding. Over time, this strategy can turn $10,000 into a sustainable income-generating portfolio for your retirement. For more simple breakdowns on finance and how it works, click the video on the screen.